Hi, everyone, and welcome to Soul Bites. This is our snackable tips, trends, and thought leadership for those in the business of talent. And we have a very special guest today, Jon Canarick, Managing Partner of NorthCastle Partners, which is a small cap private equity firm focused on the health, wellness, and active living sector. Or in other words, it's food, it's fitness, it's fashion, it's beauty. And our topic today, what investors look for before making an investment in the current market. So, Jon, a huge welcome to you to the podcast. Could you tell us a little bit about your portfolio and just some of the themes of the pandemic, I guess, what you've experienced over the last 24 months?
Sure. So great to be here. Thanks for inviting me on, Emma. The themes of the portfolio, it has been quite a couple of years for us, with some companies in the portfolio that have experienced enormous COVID tailwinds and other ones headwinds to the highest velocity you could possibly imagine, with many months of store closures. So as you kind of called out there a moment ago, the types of companies we invest in. So we have businesses that have benefited from the home exercise movement and benefited from the increase in grocery store purchases. We have an Indian food brand called Maya Kaimal. We have a casual wear brand called Mack Weldon. And people bought a lot of sweatpants and sweatshirts and the like. And so there were companies, or are companies in our portfolio, that had enormous tailwinds. And then on the opposite side, we are deeply invested, and I am personally leading a lot of the effort at NorthCastle with investments in the service, the retail service sector, fitness and non-fitness alike. And so when people are not going into four walls, or even going into four walls some months after the pandemic started, but going in hesitantly with masks on and whatnot, those headwinds were just enormous, and are at different phases of recovery, quite honestly.
Great, thanks for that overview. So let's discuss two of the brands that we're a little bit more familiar with here at Good Soul Hunting, and exactly talking to those different sets of pressures and challenges that you've had to overcome. So one being Barry's, which is formerly Barry's Boot Camp. So predominantly an amazing, perhaps the leading boutique fitness brand around the world, certainly in here in the US and beyond. So very bricks and mortar, very, if the doors are closed, businesses close. So I'm sure that's had its challenges around, just the market going away. How do you keep the culture alive? What do we do with real estate and all that money that's owed there? And then at the other end, and you did mention that, is Echelon Fitness. So a wonderful, more affordable, at home and other places connected fitness solution with a myriad of programming options there. And of course, their pressures have probably been opposite. You probably slipped into triple-digit growth at some point. What do we do with supply chain? How do we, project growth on such a magnified moment? What is normal going to look like beyond this? How many bikes and things do we provide? When is it going to drop off? So perhaps tell us about the different sets of challenges that you've had with perhaps those two brands.
Sure. They couldn't be more different in really almost every regard. So Echelon was a relatively small business when COVID started. I would say its brand awareness was probably in the 1% level. We were in a handful of retail stores, and over the course of the pandemic picked up major retailers like Walmart and Costco, more recently Target, and other well-known domestic retailers, and a decent presence in the UK as well. And investing in the human resources to manage that growth, and investing in the supply chain to manage that growth was really challenging. The technology to stream and offer all of the data that a true connected fitness solution offers. And there are different types of connected fitness, and the amount of data offered can vary greatly, right? From just heart rate or class counts on the light end to much more rich and intensive, like a lot of your audience would be most familiar with through Peloton. that scaling was also very challenging when the membership growth kind of grows at the pace and it grows, and not just the sheer number of product owners, but that often multiplies by 2 point something members per household. Everyone's home, and then that magnifies by a record-setting, number of rides or classes per household or per user, and so that scaling was really challenging. Now, of course, as you were noting, the forecasting is just impossible, and understanding how hybrid work behavior, which I think many of us are still experiencing and plan to experience, I think forever, will impact at-home fitness versus four-wall or in-store fitness. Because despite the pandemic being in a mostly endemic phase right now, and therefore people are very comfortable for the most part in gyms and studios across the country, we're still home a lot, right? Because we're not getting up at 6 a.m. to catch the train necessarily 5 days a week. We're doing it 2 days a week or 3 days a week. And so usage is still really strong, but obviously the pure demand for new hardware was at such an all-time high that the market had to have a pullback. And so managing through that is as difficult as it was on the way up, because you had the sales and the gross profit at an elevated level to pay for those investments, and now that stuff has all pulled back somewhat. Still very strong, but pulled back somewhat. And that whole category is undeniably in decline as compared to 2020 and 2021, but still very elevated relative to pre-COVID. And so finding that, like, what is our baseline has been really hard, but I think we have an understanding of it at this point, into the endemic phase, and I think we feel pretty good about our future. That category will resume growth in my best guess, whether that's Q1 of 23 or mid-year 23. I don't know exactly when it resumes growth, but something in that range would be my personal forecast. On the exact opposite side of the spectrum, the performance at Barry's in the first 2 months of 2020 could not have been better. Barry's was firing on all cylinders, super strong brand, incredible workout, great instructors, top tier management team, everything really, really, really strong. And then obviously the doors just shut, right? And a common question I get is, well, you were able to launch a home offering, and it's like, what, as a deep industry person like you and me, like that almost nothing more frustrating than hearing that from people's reactions, because the amount of money people pay for a home offering relative to a high quality experience in store at Barry's is like completely not even closely comparable. And then the ease of switching costs and the number of options out there for other home fitness offerings, just extraordinary, right? So Barry's was able to replace a very small fraction of our revenue while we were closed, and then managing through the reopening. Boy, my operations team deserves just a tremendous amount of credit, because you are talking about different opening dates per city, forget per state. It was really on a per city level. There are even local governments within Los Angeles County or within the wider Boston area that has different rules, inside of Boston proper and outside of Boston proper, on capacity, on masks. And so keeping up with the changing regulations was just wildly difficult. But the business of Barry's was built to service 50 people at a time and not 15 people at a time. And so you first had to get through the regulatory environment part of reopening, and then you also had to get the consumer to come back. And part of that was comfort. Part of that was retraining habits, right? Like, I was in the habit of going to Barry's 2 days a week or 3 days a week, and then I didn't go for 2 years. It's not like I just snapped back because I got one email and show up 2.5 days a week again, right? And so there's a habitual retraining. And then third challenge that maybe a lot of people don't think about is there was enormous dislocation on where you lived. So Barry's is a national brand, but you may have lived near one in 2019 and you live nowhere near one in 2022. Yet in most cities, someone lives there. It's just not the same person as it was before, but there's a whole new reintroduction. And so, Emma, in some ways, it's been like grand opening 48 stores at the same time. And that is really difficult, and it's different by city. Again, because of the mask mandates and the regulatory environment, the timing of how long we've been open in a full normal way has varied tremendously by city. New York took the masks off quite a long time ago and never reinstated mask mandates for fitness, whereas cities like Chicago and Boston and Washington, D.C. and San Francisco all put mask mandates back into place when the Delta variant hit. And they stayed through the Omicron variant and finally came off we're talking only a number of weeks ago at this point. So just incredible deviation.
Yeah, thank you so much for sharing those examples in such deep detail as well. I mean, it's very obvious that you're locking arms with the management team, with the executive of your portfolio, basically, and sort of marching through this together, and very unknown. This has never happened before. Like, let's find out as we go. At the same time, as like you've mentioned, the operational team, it's exhausting. It's exhausting. Yeah. It's exhausting not knowing, and it's exhausting having to do all the doing and then having to do all the variants of the doing, like just by city, by state, by club. So, I mean, congratulations and keep going, and we are going to pull out. Let's now talk to the topic at hand. So how many pitch decks, and maybe you're just focusing on your current portfolio right now, but how many concepts or pitch decks would you review per quarter or annually?
Yeah, a lot. And yes, I've been more focused percentage of time on the portfolio because we do lock arms, and our teams have done a phenomenal job. And both businesses are largely through this sort of really choppy waters of figuring out what normal is, and Barry's is very far down the recovery curve at this point. But so anyway, I would say we're seeing a couple of businesses a week come through the doors, and so we're going to put that on a quarterly basis, probably in the 30 to 40 range. But that does vary from maybe one a week that is a really qualified type of investment that NorthCastle is going to take a serious look at, to stuff that's really earlier stage and not totally appropriate. And we may take meetings anyway, and with full disclosure, of course, that we're not at the right stage for investment. But a big part of what we do, Emma, is planting seeds, as we call it, getting to know people, building relationships, so that when those businesses may grow up and become the right size for NorthCastle, there's a relationship there.
What is the sweet spot for you? When do you love to get involved in a business?
Yeah, so we divide our world into two sectors. So the number one sweet spots, are 2/3 of our capital is going into businesses with call it north of 4 million of EBITDA or cash flow proxy, and that could have 20 million of revenue, that could have 50 million of revenue, obviously. So we think about profit profile and taking a rather large, most often in those cases, control stake in the business, or very substantial minority, and it's both an ability to put capital on the balance sheet and a wealth event for the founders. Over 90% of our investments over the 24 years we've been doing this have been with founders. So first, still the original group in charge of the business, and then the other kind of 1/3 of our capital goes into more growth equity situations. And there, I would say a minimum of 15 million of revenue, and a modest loss profile. We're not deep loss investors. There's a perfectly good place for that, but that's not our sweet spot.
Got it. Really, really cool. So what do you specifically look for as an investor? Like, what are the things that must check the box in order to get, your team involved?
Yeah, so it all starts with people. Everyone will tell you that, and this is no different for a lower middle market firm like NorthCastle and the biggest firms like Blackstone and KKR and whatnot. People, right? So we're often, again, starting with entrepreneurs. In our case, that's where it does change for entrepreneurs to professional CEOs. But having not just a belief that entrepreneur has a really fantastic vision and passion, but also someone that we just personally can connect with. And so we look at that from both angles. Where NorthCastle is probably more flexible than a larger firm is the layer underneath that person. We often do get our hands dirty, partner with that person or couple in some cases, to hire a more professional CFO and chief marketing officer and supply chain person, construction in the case of our retail development companies. So that's where we are less concerned about perhaps not the strongest level, but it all starts with people. And from there, a brand that we feel like either is already kind of quote unquote there or has the guts and can be developed into a brand that consumers will love. More often than not, we're at the premium level, but there are examples where Echelon is a mass market, and we just love that opportunity to be able to partner with the entrepreneur to help develop a brand and deliver product that was much more mass market in nature. And we love that opportunity to bring wellness to a larger audience. And so obviously Barry's is at the very high end and Echelon is really more at the mass market. So we do kind of both levels. So we think about people first, brand, and then obviously just category and category dynamics and competition, and whether we think it's a strong growth category or a category that may be more faddish in nature are things we often have long discussions about internally.
Do you always get it right?
Oh, no. I wish we always got it right. No, we certainly have our failures. We have tremendous successes and also businesses that just did not work out and hit a wall from a growth perspective, either because of more intense competition than we originally envisioned, or category issues, or just straight business model issues that we thought we could sort of scale in time and become more profitable, and we didn't get right. So I think we have an advantage on getting things right because of our sector expertise and seeing things repeatedly. But we also, whenever you invest in smaller businesses, you're going to have those mistakes.
So you're human after all.
I'm most definitely human.
Well, that's great. Hey, look, we were recently in LA together on this investment panel. You quipped that there was too much money out there. Could you perhaps give us a little bit of context of that fabulous conversation? It was an incredible panel, and why you responded as such.
Yeah, well, we were talking about the growth equity side of the business. We were talking about businesses that had, I think, relatively strong revenue growth foundations, but also relatively large loss profiles. And in that context, I do believe that a lot of businesses received funding at both valuations and quantums that don't make sense for what their reasonably likely long-term business outcome is. At the end of the day, the value of a company and the amount of capital a company could or should attract is in some way related to a long-term view of how much profit that business can make. And sometimes it's not necessarily as a standalone, right? Many businesses are built to be sold, and investors believe that as part of a different engine, there'll be a lot of profit to be had. And so they're willing to invest into large amounts of money at high valuations into large losses. And sometimes that's very logical. In some sectors, it's very logical. But what's happened, Emma, in my humble opinion, is the convergence of technology and consumer, because technology is everywhere in our lives, right? So obviously those things are inevitable, has brought a technology mindset in some ways where when you get a technology company right, the gross margins are extremely high, right? That's the thing about tech, it's very repeatable at low costs, whereas consumer products have a real cost. Every time I deliver a bike at Echelon, that has a very real hard dollar cost to it. And sometimes the mentality of tech and the mentality of consumer don't work as well together as perhaps people wish or think they should. And so valuations for businesses that can never, ever have a profit stream that matches that from any logical standpoint at any aggressive multiple starts to get out of whack. And so what we were talking about there and what I said there is the amount of capital a category has attracted can lead to very bad decision-making by companies in those spaces. And I think connected fitness is front and center. in that. And I'm in that category again with Echelon. Obviously, Peloton is famously there, and a lot has been said about the capital inefficiency of the business. And I say that with tremendous respect. I have tremendous respect for that business and that brand and what they've accomplished. But lots of businesses in that category, because of COVID, received tremendous amounts of capital and at valuations, I believe, would make the calculation into the tens or hundreds of years before that capital can realistically be paid back from a cash flow perspective. And that's not terribly logical in business.
Right, great answer. And then just, I guess, looking into the next year or two, what do you think will happen in the investment environment? I guess, everyone was throwing SPACs under the bus for exactly that reason. There was all of that. What do you think will happen? We've got inflation, gas prices, all that sort of stuff. We've got this coming out of pandemic. We've got a settling to who knows what. We've got behavioural change, real behavioural change, which is actually being affected by how we work and who we are and what our priorities are. So bigger than just fitness, actually who we are and our role on the planet. So what do you think from an investment perspective will happen over the next, say, 24 months?
So there's already been an enormous change in valuation mentality. That started to happen kind of right around the turn of the year. And if you look at high growth public company consumer names, you'll see a meaningful decline in the revenue multiple or EBITDA multiple that they're trading at publicly. And the private markets always mirror, in some ways, what you're seeing there. So the changes are kind of very, very similar in outlook. I think there's a lot more scrutiny being applied to the long-term profit-making ability of businesses. I think some of that rationality has come back into the market, and I expect it to stay. I think some of the large capital and valuations were a reflection of just how low interest rates were for so long. And now obviously all the talk, if interest rates are going back up and, a mortgage is now 5% and not 2.5%, right? I mean, these are big differences. And so investors can get yield or get return in different places now that wasn't necessarily there 6 months ago. And I think all of that just leads to a harder funnel on getting capital out from investors and into companies. Having said that, let me just caveat that a little bit by the other side of the coin, which is the supply of capital is still really high. And there are only so many places to put it, right? And so, investors still want to invest. And that's what there's an enormous infrastructure of hedge funds and private equity firms and venture capital funds that have a lot of people like me whose full-time job it is to find great places to put money to work. And, when there's a lot of effort, there usually is a lot of output. And so that'll be the force that works against the other part, what I just said. But it's going to be a pretty rocky 12 months, Emma, in my opinion, whether there's a recession looming or not, 9-12 months from now, I think we'll see. A lot of people I think, believe that there is and has not been one in a very long time. That's not necessarily a really bad thing. It could be a minor kind of corrective recession that rebounds 6-12 months later. That's what I would expect. I'm not expecting something catastrophic. And so you'll still see good, solid business fundamentals run by great people attract plenty of well-valued capital.
Look, thank you so much for your incredible insights, and also congratulations on just surviving. This is the first time we've ever been through this. Let's hope we don't go through this again, but really we have learned a lot, haven't we? And we've also learned some efficiencies. We've seen technology come forward perhaps a decade. I mean, it's been quite extraordinary. Jon, what sets your soul on fire? This is a question we ask all our guests.
There's nothing I love more than partnering with great entrepreneurs to build great management teams and brands that consumers love. And that's why I do what I do. That's why I've been at NorthCastle for over 20 years now, is the drive to both find those great entrepreneurs managing great brands, but more than find them is to partner with them to help build and create value for everybody involved. And it's great people and great brands that I guess sets my soul on fire.
Oh, that's great. And thank you for everything you do for our industry. And I thank you very much. I know that I've bust into your family vacation in Florida, but I very much look forward to seeing you back in Miami, actually, for Ursa in June. So thank you so much. Really, really appreciate everything that you do.
It's great to be here, Emma. Thanks for having me.